Welcome to your Monday Futures Market Outlook for July 11th, 2011. This is Patrick Sresna. For those of you that have not had the opportunity to try out EmuniSource.com's trading room, 5-day complimentary memberships are available. Start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that the market has gone through. We crossed back above this 80-week moving average back in 2009 and subsequently have remained above there. The consolidation that we've seen right here, it continues to just appear as a market correction and not as a major reversal. So we're waiting to see where and how far this consolidation goes over the summer. But if this is the extent of the selling and everything holds above the 1200 level, we should very easily see another rally at the year end. To highlight some of our key intermarket observations, the primary trend of the market remains bullish. We were looking for that second quarter market correction, but like I was just saying earlier, unless we see negative price action below the 1200 level this summer, we should see a bullish second half of the year. The biggest variable in the third quarter will be the U.S. dollar. We continue to see even this morning a little bit of U.S. dollar strength, but the commodities continue to relatively hold up during this environment. If the U.S. dollar, for whatever reason, breaks down again, it would naturally lead to a strength in commodities and stocks as well as weakness in bonds. So we're waiting to see how that U.S. dollar trend plays out. When we take a closer look at that S&P 500 on the daily charts, you can see that we worked all the way up to the previous highs for a retest up into that 1355, 1365 focal point up above. Really at this stage, there's some negative reactions to the jobs numbers that came out on Friday, which is more than likely going to continue to see some further consolidation in these markets. And while it would be very natural for these markets to work their way back to 1320, 1310, it will be crucial to see how the bulls acted in this blue boxed area. If we see a sell-off that lasts the remainder of the week or a portion of the week, and it really is contained above the 1300 level, really at that stage there's room for it to all turn bullish and make another leg higher. In the same regard, if those support levels don't hold, and especially if it takes only a few days to cut through them, then we could be looking at a scenario where we're going to go retest the whole bottom end of the trade range that's all the way to 1250, 1260 area. So the most important thing will be on Monday and Tuesday to observe the degree of the selling and where the bulls may draw their battle lines. Next year, I want to take a look at the U.S. dollar index futures, and this is one of the key intermarket pivots we're watching. The U.S. dollar, in spite of all the situations in Greece and everything going on in Europe, has really not been able to muster up nothing more than more of a sideways kind of flagging formation. Really at this juncture, even as the U.S. dollar strengthens back up into the 76 and a quarter area, it's coming back up to where all the overhead resistance levels lay. Even a temporary pop up to 77, 77.50 would, in the bigger picture, not really change anything from the cycle panning out. Overall, unless the bulls really grab the U.S. dollar by the horns and really create a solid bullish break that convincingly puts the U.S. dollar into a new uptrend, then we really will be anticipating this to roll over. When we take a look at copper futures, they have strengthened considerably over the last week or two. Just like with the whole stock market, we're going to probably see a little bit of a backfilling move as copper tries to find its footing. The most important thing for the copper bulls is that they don't let the copper make a lower low. They already accomplished that in the month of June, where it looked like copper was rolling over, but the support lines held. We want to see a repeat of that here in this week, where there might be some selling, even 1-2 days of more aggressive selling, but so long as the bulls contain all the selling to support lines, then it could all roll up and turn bullishly. Next year, I want to take a look at gold futures, and gold continues to consolidate in a sideways flat. It's created a new support resistance range. We were looking for original pullbacks in gold to even go as low as the 1420, 1440 area. Never really got that at this juncture. We have to treat gold as a range-bound zone with a significant overhead resistance in this 1560 area right up above. Really at this stage though, we're going to be watching for clues whether the bulls or the bears will really break this sideways channel. But for now, treat gold range bound until there's a new motive for a breakout. Next year, when we take a look at crude oil has also had a really nice bounce higher off of its 90 and 92 focal point down below, which is where all the highs came in December and January. Really at this stage, very rarely will you see a commodity like this bang out a V bottom, which means that more than likely crude oil, especially during this period of low US dollar strength, could come back down for a retest. As crude oil comes in and retests those zones below, the most crucial thing is to watch whether or not those support lines hold. We don't want to see crude oils make lower lows. If crude oil does break to a lower low, then we could see a move all the way down to 85 or lower. So really at this stage, all the oil bulls really want to see is that the support lines hold here during any consolidation. Finally, when we take a look at the 30-year Treasury bonds, they popped very bullishly on the jobs numbers, and really at this stage, they're heading right back to the bigger overhead resistance where it spent almost the entire month of May and June consolidating up along those upsides. We're not necessarily bullish here or bearish on Treasury bonds. In the bigger picture, if Treasury bonds fail at these levels, maybe in the fourth quarter going into 2012, there could be another bearish scenario. But really at this stage, we're treating them far more range bound, and we'll see whether or not Treasury bonds make a higher high or whether they find significant overhead resistance. That was your Monday Futures Market Outlook. Thank you for joining me.